All right, what up? It's Rim from TG, and in today's video, I'm going to give you the best trading strategy. This works for stocks, options. You could apply this to any product asset that you want. Actually, you could do crypto, you could do forex, you could do all of it. I'm going to explain to you where the real edge comes in trading. Okay, uh, but before I show you, because I wrote about this in my community, which you can join. There's a link in the bio if you want to check that out. Um, there's a quote. There's a quote by a famous investor slash trader. His name is George Soros. And George Soros said something around the line. Let me see. It's not whether. Let me see. We can. It's not whether um, you're right or wrong, but how much money you make when you're right, and how much you lose when you're wrong. All right. This quote is so important in the world of trading, whether it's options, whether it's stocks, whether it's crypto. I'm going to give you a real life example here. And this is something that I had a conversation with one of my students, because like most traders, and I was in the same boat too, you have this, you put this pressure on yourself to want to be right all the time. In a way, you're kind of like, the ego kicks in, right? Because we're technically timing the market. We're thinking, hey, this is where it's going to be the bottom. This is the top. This is where it's going to be sideways. And to some extent, that's not how the market really works, right? The market is going to do whatever it wants. It does not care about what you think or how you think about it or if you think it should be there. And it's going to do its thing, right? And so by us trading and getting into a certain trade, we're thinking that this is the bottom, this is the top, this is where it can go, this is the price targets, right? But anyways, the point is, this is really important. We put this pressure on ourselves of having to be right all the time, and a lot of traders don't think this way. So what this is saying, and this is where the biggest edge comes into play, is that you don't have to be right all the time. Okay, a lot of traders ask me, what's my win rate? What's my win rate? I haven't tracked this in a long time, but I think last time I checked, it was about a 50% win rate. That's really low. And a lot of the times you're going to see on social media, you're going to see on YouTube, high 70, 80, almost 90% win rate. And even though that's impressive, that doesn't answer the question, how much did you lose and how much did you make? Okay, so this is a question I get asked quite often, and it's the wrong question to ask. The better question to ask anybody that you're looking to trade with or learn from is, what's your RVR? Another way of asking this is, so I'm going to say this is the wrong question. I'm going to say wrong question. This is the right question right here. What's your RVR? Right question to ask. What's your RVR? Another way of saying this is, what's your R score? And essentially what this means is telling you, for every dollar that you put on the line to risk, how much are you capable of bringing back to your pocket, right? And so this is where you hear a lot of like the risk versus reward. In a sense, and what I always tell everybody is that and I'm talking about the stock movement, not the price of the of the option, okay? Because those can vary depending on theta. It has so many factors in there. But what we try to aim for here is a minimum of 1 to 3 RVR, risk versus reward. Risk versus reward. That's what I aim for. Okay. And by doing this, and sometimes, FYI, sometimes this is the minimum. But when I look at the macro things of like a monthly time frame, the EPS growth. Sometimes this is actually sometimes this is a 1 to 8. Okay, but this to achieve this takes a long period of time. That's why I swing trade a lot of the time, because I know that this is going to take a while. It's not a matter of if, it's more of like when it's going to happen. And for this kind of macro play, it requires a lot of patience and swing trading, leap options, 8 months out, stocks, even if the percentage of the gains is there. And so this is the important question to ask yourself. Okay, even as a trader for your own personal stuff, this is how you win. This is the best option trading strategy. Okay, because there's a lot of strategies out there, and they all work to some degree. Okay, not that I have my own personal bias on my strategy and how I trade, but at the end, all the great traders that I've traded with, that I've learned from in the past, and the ones that I teach my students, is this. This is the main thing right here. It's what's the RVR that what's the main question? Anytime we get into a trade, we gotta ask ourselves, is this a good risk versus reward? If the answer is yes, then you take your shot. If the answer is no, then you pass on it. I don't care how much it makes you feel like you're not making money or you're losing. It has to meet the minimum risk versus reward. Okay, I'm gonna give you an example here that I gave in the. Actually, I'm just gonna read this to you because this might be better just to read it out loud. So I said here, 50% win rate, still profitable. Here's how you do it. Most traders obsess over win rate. But what if I told you that you could lose half of your trades and still come out on top? Let me break this down, right? So here's a concept. Profitability equals win rate times average win in dollars minus loss rate and then average loss in dollars, right? And that is it. It's not about just how often you win. It's about how much you win when you're right and how little you lose when you're wrong. The win rate, 50% total P&L. Oh, this is an example, okay? $560, not bad for being okay. So that was just supposed to be part of an example. I'll show you the math to this here soon, which is in this image, but I'll do it on Excalibur. I said the real edge in this type of mentality is that winners are big, losers are small, risk per trade is consistent, and no revenge trading, just execution. So here's the example I gave, because I was teaching this to my student who was actually, let me see if I can just screenshot this because I have it right here. I'm gonna just screenshot this. This is like just an overview picture of the strategy that we're using. But I just marked here like where was the entries, where were the exits, and here you can see. I'm gonna actually put myself here, make this a little bit smaller. You can see here. Okay, I mark here trade one. Let me see if I can mark this. Trade 1, 2. Maybe I don't even know how to count. Mark 2, 3. Okay, this is 3, 4, 5. Is that it? And 6. This might be 1. 1, 2, 3, 4, 5. Okay, I only marked 5. Whatever. Okay, so what happened here? Okay, if you take I marked when I was going. This was an example I gave to one of my students, and I said, here is how we would have entered what our invalidation criteria was. And if you would have seen just in the equity itself, you could see that I said here, here's a 50% win rate, right? Here's the, if you would have taken a position of $1,000 on trade 1, right? I'm gonna make this small. Trade 1, okay, of $1,000. And this was a loss. I marked it here. Trade 1 minus 4%. So equals minus 4%. Okay. Trade 2, we got invalidated fairly quick, but at a smaller. This is $1,000, and this was which this equals about $40, $40 in loss. Okay, I'm gonna mark this. Can I do that? No, it does the whole thing. Okay, we're just gonna do this. This was minus 3%, which is about minus $30. Okay, trade 3 was a big win. 1, 2, 3. This was about a 56% return of $1,000. 56% return. So that is about $560. Trade 4 was this one right here. I marked it as trade 5, but that's not right. $1,000 trade. We lost about, let me see what we got here. 1% return. Okay, so that's a 1% return equals $10. And then we had trade 5, which was a 9% return here. I marked it here as trade 6, but it's not trade 6. It's trade 5. Okay, fine. So be it. Doesn't matter. So this is going to just prove that I was right anyways. And this is about $90. Okay. So, and this was a loss. This is a loss. So minus. Okay. So what this shows already here, and you can see it clearly, we took 5 trades. Okay, 5 trades. And the risk versus reward is always the same. Okay, we're aiming for high risk, not high risk, low risk, high reward setups, 1 to 3 minimum. And in the example of QBTS that I was giving him an example of, we lost about on the first trade 4% because we got invalidated. We lost 3% on the second trade, and we lost about $30. The first trade was $40, so that's $70 total loss. But the third trade was a 56% return on just equity. And notice how I said we're opening around this area right here, which is like the close of a daily time frame, and we got out at the close of a daily time frame. That was about a 56% return on just equity shares, and that's about a $560 return. And then trade 4 was only a 1% because we entered right here and we exited right here. And then because this met our exit or our stop criteria. And then trade 5, we entered right here on this candlestick right here, and we exited on the end of this daily time frame. That's a 9% return in just equity. I mean, that's a huge move in just equity alone, and $90 return. Okay, so you can see already that these two right here we're gonna create some arrows here. Now we're gonna say these two equaled about like $70 loss. Okay. And all of this together, right here and right here, how much is that? Let's do a little bit of math here. 560 plus 10 plus 90 is about $660 of total profit, plus $660. And now we just got to do the difference between that. So 660 minus 70, which I can't do basic math, 590, okay, in total profits. 590 profit. So you can see here that when you have a strategy that takes into consideration risk versus reward, you win. And you can have a less of a win rate. What's the win rate on this one? This is only 5 trades. So we won 3 out of 5. That's a 60% return, okay? If we would have had another loss and it was a average loss of 4% on the equity or 3%, we would have still come out profitable. But there's a key here, okay? If we go back here to this post, I said, here's a key. Risk per trade is consistent, okay? I used to run a journal trading software or trading journal software, and I would see in the data people sizing in to trades like one trade is $20,000, and the next trade is 40 grand because they doubled their cash on the 20K. And then they lost a lot of the money, and then the next trade is $1,000. Like, there is no consistency. Your P&L, instead of it looking like this, I'm actually going to show you something here. I'm going to go to one of my students just he just made $100,000 on his trading account. You can see here he started at 5.5K, and now he's at 100,000. Look at his P&L. It's nothing out of the ordinary. It's a pretty linear growth. This is an impressive result that he did. Okay, but he's following the same strategy where it's risk versus reward. It's always about risk versus reward. And so his P&L, and because of consistent position sizing, is this boring slope. It should look something like this. Okay, it should look something like that. That's normal. But when you size in 20K, 40K, and then the next $1,000, you're going to see things like this. And more than likely, you're going to blow your account. And here is zero. Okay? It's not something that you want to be into. That is not where the edge is. That is not how you win. That is not part of the trading strategy that you should do. Always stick to consistent position sizing all the time. I don't care if you have $50. I don't care if you. There's people that I trade with that have $50 only. There's people that I trade with that can go into a position size of 20K, and that's still risk management. Okay, that's not them blowing their account. That is small relative to their account size. They can go into a position of $70,000. That's relatively small to their position, to their account size. Okay, so no matter what the game is that you're playing, sizing is everything. Because if you can have a solid risk versus reward, but if you can't do your sizing correctly, you will lose, no matter what. Okay, let's go back to this post. I'll talk about Sewell's win later, how he did it, how we achieved it for him, because it's an incredible story, and the next steps that he's going to take, it's truly amazing, which I will post in the next video for sure. Okay, no revenge trading. Okay, so what this requires you to do is that you need to be in love with the process of being consistent, okay, and having good risk versus reward strategy. Finding opportunities that provide this at the minimum, or better yet, this 1 to 8. That's really good. And that takes time. You don't find that very often. That takes time to find. Sometimes you don't find a trade for 2-3 weeks. That's okay. Come back when you can find one. Okay, this is how you build durability in your trading. No chasing, no praying, just basic math and discipline. That's really it. That's the best that we got as retail traders. Okay. If you're in a firm, then you have all kinds of models and high-tech leverage. But when you're a retail trader, you need discipline. You need basic math. Okay. Probability and statistics will take you to the next step. So what you can learn is that you don't need a 70 or 80% win rate to grow your account. You focus on risk reward, not being right. Okay, get that out of your head. Let your winners breathe. Cut your losers without ego. That means you got to be systematic. So here's the real question. Are you trading to be right, or trading to get paid? And this is actually a really good question, right? Really, like, ask yourself, do you want to be right? Do you want to be right? Or do you want to get paid? Okay. That's a solid question to ask yourself. Because if you want to be right, just be an analyst. Don't even trade. But if you want to get paid, get a strategy that is this, and focus on consistency on position sizing. That is the best option trading strategy that you can follow along. Okay. I know I talk a lot about Dextron and the levels and how to stay ahead, and that's all wonderful. But if you can't do this, you can't do this, you will lose. No execution strategy is gonna come save you. You will lose in the long run. You might win in the short term, and if you do, awesome. And I hope you can keep that. But if for the majority of people, and this was myself too, back when I first started, I lost big time. Um, Actually, let me show you guys a website here. Most of you that come through my site probably have visited a page like this. Okay. Um, Here are some of the wins that I used to do with SPX. I used to be a big SPX trader. Okay. This was back in 2023. So you can see the timelines. You can see here 500% returns, 1,000% returns. Like these are real trades that I took, 1,000% return. And I'm going to give you something 200, 520, 1,000, 1,000. And then the next rows are different ones, I believe 400, 61, 72. I mean, these are real returns that I had and massive wins. And I'm going to tell you a story. One time I got cocky and I oversized and I lost about 50% of the profits there. That sucks. Okay. All because we're in 25. This is when I was just getting to start, like, okay, how to put the pieces together. Okay. And I haven't really mastered my emotions or my risk management at that time yet. So I started 2021 options. 2022 was failure. 2021 was a failure. 2020, everybody gets lucky. Everybody won. 2023, midway 2023, I started getting my foot in right, and then risk management, and position sizing came in like days after that. Okay, or weeks after that. So it was really a process. But find something. Just be consistent with this. Be consistent with this, and you will win in the long term. All right. If you have any questions about this, um, leave a comment down below. I like answering those questions. And if you want to join me and my team and learn and trade side by side with me, I'll put a link in the description as well too. And I will see you in the next video.